Hey, what's up, guys? My name is Marsay, aka the Property Pastor. I'm a real estate investor. I'm a husband. I'm a father. I'm also a pastor, and I work a 9-to-5 job. I've been blessed over the past 3.5, 4 years to purchase 13 rental properties, and to build my portfolio as I work on financial freedom. And today I wanted to share a few tips with you that I use in my business that have helped me to be successful, that have helped me to grow my portfolio, and I want to actually help you as well. So today I'm going to be talking all about how to calculate cash flow. If you're terrible at math, maybe the subject intimidates you, no need to worry. We're going to go through an example today, which is some simple addition and subtraction, and you can have confidence knowing that the investment that you're looking at, whether or not it's going to cash flow positively. So I want to thank the folks over at Rent Ready for partnering with me on this video. Rent Ready is a great software that I'm using in my business to help me keep track of tenants, to handle maintenance, to do screening, to actually collect payments, and so much more. If you're interested in trying the Rent Ready software in your business, click on the link below for a special discount. Also, if this content is beneficial to you, make sure you hit that like button. Also, make sure you hit that subscribe button. By hitting that like button, this video is going to go out to so many more people who need to see it, that can benefit from it. And by subscribing to this channel, you're going to be keyed into some of the great content that's being published on a frequent basis to help you in your business. So let's go ahead and get started. Let's talk about cash flow. This number is important because cash flow is going to actually allow you to determine whether or not a property is going to make you money. Now, it makes no sense to buy a property that's not going to make you money. That's a really easy way to get into and out of the real estate investing space. But cash flow is the name of the game. So we want to talk about one of the most important aspects, one of the most important calculations here today. And we're actually going to work through an example together. So you're going to need to grab some paper, grab yourself a pencil, grab yourself a calculator, and let's go ahead and get started. So as we get started, I'm going to give you the formula for calculating cash flow. It's very simple. It's income minus your expenses, right? So all we're going to do today is actually go through the sources of income, which for us is going to be rent. And then we're going to look at all the different expenses you would typically have on a property. And at the end of it, when we add up whatever the income is and we subtract the sum of the expenses, it's going to give us an estimate of our monthly cash flow. And that is a very important number. As you're looking at different properties, you want to know whether or not that property is going to meet and achieve your cash flow targets. So let's look at it. So we're actually going to look at an example property that is going to bring in about $1,500 a month. So, your numbers may vary, depending on your market, but on your paper, I want you to write under income, write down that number 1,500. So write the word income and then 1,500. That's what we're actually bringing in each month through our rent collection. Now you want to make sure that you account for vacancies. Now I usually use a number of about 5%. So 5% vacancies is a pretty safe estimate, but you want to account for that because whenever a person moves out, they get evicted, things like that, you're going to lose some income during that time. So 5% is a really good rule of thumb. So we're just going to make the math easy and say that after our vacancy allowance, our net income is $1,500. So that's what we'll go with. Now let's look at the expense column, because you're going to have a lot of different expenses. Now you want to make sure that when you add up all of those expenses, they're not more than your income, because then you're cash flow negative, which is not where you want to be. So some of the things that go into expenses are, first of all, insurance, right? So for insurance, typically those numbers are going to vary based on what kind of coverage you get. They're going to vary based on where you live, which company you use, so on and so forth. But at a minimum, you want to make sure that your insurance is going to have liability. That means if somebody falls, they get hurt and things like that in their property, you want your insurance to cover that. But then also the dwelling, if there's a fire, if there's any kind of damage to the property, the dwelling itself, the roof, the 2x4s, all of that stuff, the plumbing system, that they're covered. So you want your policy to make sure at a minimum they include those two components. But in order to get an actual quote, and I recommend, typically we use kind of general rules of thumb. If you've done this for a while, a good place to start is just go to whoever provides your home insurance and say, hey, I'm looking at an investment property, give them the address. I want these things in my policy, and they'll give you a quote pretty quickly. Typically that can be done, within the space of a few hours. So for our example today, we're just going to use a nice, easy number of $100. So for this property we're looking at, our insurance is going to cost us $100 a month. Now let's talk about taxes. Every property is going to be taxed. Now, this is an expense that comes with the property. And in looking in taxes, that rate is going to be determined by your city or county where you live. So that's public record. You can look on your county website. Typically, they have a web search that you can do. Just simply punch in the address you're looking at and it will give you the tax rate. You can find previous years, you can find current years, so on and so forth. But again, that's going to be determined based on the tax rate of your city or your county. Now, this number is based on an assessment and not an appraisal. An assessment basically means the county or city assessor comes and assesses a value to a property versus an appraiser, right? That's a whole different word. Appraisers look at the sale price. Assessors look at what the county wants to base their taxes off of. So you want to know the assessed rate or the assessed tax rate for that particular property. And for example, we're going to use $100 just to make the math easy. So let's talk about repairs and maintenance. So repairs can be anything from a stopped up toilet. It could be a leaky sink. It could be a bug issue, a pest issue, anything, just the wear and tear on a property, the repairs and maintenance. It could be lawn care, maintenance and things like that. Those are what go under your maintenance costs. And typically I find that these range from about 5 to 8%. But it really depends on the age of the property. If you're buying a property that has had a lot of deferred maintenance, it's going to require more maintenance when you purchase it. Or if you're buying a property that's turnkey or just underwent a rehab, you're going to have a lot less maintenance in that property, right? But for our example, we're going to keep the math easy. We're going to use a number of 100. We're going to use $100 for our repairs and maintenance. So hopefully you're writing this down so far. We've covered insurance, we've covered taxes, and now we've covered maintenance. All of those are $100 each. Then we want to talk a little bit about property management. Now, the going rate for most property management companies is about 8 to 12%. So I like to use typically a number of 10%. So in our example, we have our income was $1,500. We're going to charge property management fees of $150. Now you may be saying, well, Marsay, I don't need a property manager. I'm going to manage the property myself. I'm going to keep that money. Now, the thing is, I always recommend people still calculate property management, because in 3 years or 5 years, you may find that you no longer want to manage the property. But if the cash flow is dependent on property management at 10%, so if you're saving it and now all of a sudden you have to hire a property manager and you start losing money, well, it really wasn't that great a deal. So you really want to look at long range planning and still charge yourself that property management fee, because you may not always want to deal with late night phone calls. You may not always want to deal with having to schedule maintenance. You may not always have to handle evictions and rent collection and things like that. So it's good up front to go ahead and calculate that number. That's one thing that I always recommend people do. So definitely calculate property management. So we're going to write 150 down under property management. The next area that we're going to talk about is utilities. Now, every property does not have utilities because a lot of times those are passed on to the tenant. Typically, the only time that a landlord will pay utilities is if a property is a small multifamily unit and the meters are tied together. So for example, you could have a duplex, but there's only one water meter. Or you can have an electrical connection and there's only one electrical service meter. So the landlord gets that bill because they can't necessarily split it between the two tenants. Now, I always recommend that you find a way to pass that cost on to the tenant. A lot of times what people will do is they'll just take the annual cost and say, on average, this is what it is. And then we divide that up and we add it to the tenant's rent. Most tenants will expect to pay their own utilities. So I highly recommend that you keep this cost to zero if you can help it. But then also we want to talk about a number called CapEx. Now, CapEx is short for capital expenditures. Now, the reason that you want to accommodate for capital expenditures or CapEx is because things are going to break. Over time, the AC unit is going to wear out. Over time, the roof is going to need to be replaced. Over time, you're going to have major systems within your building or your property that are going to fail. And if you haven't been setting aside those funds, then it's going to hit you like a ton of bricks. So typically what you do as an investor is you set aside money every single month from your profit so that when those things come up, you're able to pay for them without having to go into your personal funds, right? So CapEx is a very important number. Typically, I recommend accommodating for about 5%, anywhere from 5 to 10%. For our math today, we are going to use a number of $75. We're going to save $75 every single month for capital expenditures. Now, after you get several properties, you don't have to have a lot of CapEx built up for every property because the likelihood of an AC unit going out on all your properties at the same time is very low. But you want to make sure that you set aside some money every single month. The last expense that we want to talk about is the mortgage. So the mortgage is typically going to be your highest expense on a property, but the mortgage is when you've gone to the bank, right, and you've actually taken out a loan to purchase that property. So in our example, we're going to, typically the mortgage is going to, at a minimum, the mortgage will cover principal and interest payments. Now, many of your mortgages will already have their taxes and your insurance. If those numbers are already taken care of through an escrow, then you don't need to double count them. You want to make sure that you know what goes into those numbers, but principal and interest at a minimum are what's going to be in your mortgage payment. So in our example, we're going to use a mortgage payment of $650 per month. So that overall, those are our major expenses. You may have things that come up, right? Like, things like postage or administration fees and things like that. So you can throw a few dollars in for that. But for the most part, we've captured the main expense categories that we need in order to calculate our cash flow. So let's look at what that actually is. All right, so let's look at our numbers. By way of review, cash flow is simply our income minus our expenses, the amount that's left over. If that's a positive number, we're cash flowing positive. So in our example, we had income of $1,500 after our vacancies. And then on the expense side, we had $100 for insurance. We had taxes at $100 as well. Repair and maintenance was at $100. Our property management costs were $150. Our CapEx, we were saving $75 a month. And then our mortgage was costing us a total of $650 to pay our principal and our interest. All of that together equals $1,175. So we started out with $1,500. We're gonna spend $1,175 a month on our expenses. That actually leaves us with a total of $325 each month that we can count on as positive cash flow. So that number gives us an estimate of what we're going to make every single month. Now, this is very important because this number is going to allow you to compare a lot of different properties. So we get a little bit of information. You can compare multiple properties to find out whether or not it's a good investment for you to meet your goals. Now, I highly recommend that you set goals for what you want your cash flow to be. If you want your cash flow to be $500 per month, this is probably not a good property for you. But if your goal is only $250, right, this is a great property for you. It actually exceeds your cash flow goals. But understanding your market, understanding what rents typically are, understanding what houses typically cost, and then understanding some of the variables that will allow you to actually calculate your cash flow. So this is something that you can use in your business. You've actually done it. So if you were terrified of math, you're terrified of like, how do I do this? You actually just did it. You did an example of calculating cash flow on a property. Now, we did it by hand today, right? With a calculator and a sheet of paper. There are a ton of online calculators out there, Microsoft Excel versions of it. You can download them. A quick Google search will actually provide that for you. But I recommend for your first few properties, you actually do it by hand because that's going to help you to understand it. That's going to help you to apply it. That's going to really lock it into your brain. But again, you actually want to calculate this. This is something on every single property. I would never purchase a property without calculating the cash flow, without estimating what the cash flow would be. You should never purchase a property that way. And also recommend that you always purchase a positive cash flow property. Some people purchase properties with hope of appreciation. The issue there is that property may or may not appreciate the way you expect it to. And if it's not cash flowing positively for years, and that money's got to come from somewhere. And you want your tenants to pay for the house, not yourself, right? So as you do these calculations, they'll give you confidence in purchasing a property, and that's cash flow. That's how you calculate it very simply. If you have questions, make sure that you drop them in the comment section. If you have comments, make sure you drop them in the comment section there as well. I'm here to answer those questions for you. We're here to answer those questions for you. I want to thank the folks over at Rent Ready for partnering with me on this video. Again, if you want to tap into Rent Ready software, it is amazing. I use it in my business. Make sure you click on that link in the comment section to take advantage of the special discount code. Also, make sure you like this video. Make sure you subscribe to this channel. We're bringing you great content every single week. Thank you so much for tuning in. Again, my name is Marsay, partnering with a great team over at Rent Ready. You learn how to calculate cash flow. Now it's time to put it into practice. You got the skills, you got the tools. Put them to work, and they'll work for you. Take care. Can't wait to see you again soon.